So black swan events. When we decide a consensus about what's expected, we're bridging the past to the future, but the model can't capture what's not expected. And so you can have catastrophic failures. There are lots of big and small issues where the model is not accurately tracking reality, and when it diverges enough, you have something catastrophically fail. This is put together to try and understand the war in Afghanistan for the United States forces when they were in Afghanistan. And so they put down all these factors and they linked them up in all kinds of ways, and they came up with this. So two things are true. First of all, I'm boggled. I have no idea how to, figure out a useful thing that might be done in that particular situation from this. And second of all, they actually did wind up having to withdraw from that because whatever they were doing that this was trying to guide them on did not work ultimately. So the model, the complete model, was not accurately tracking reality. In terms of blockchain, you can't really accept a black swan event. There was a blockchain came out in 2017 or so, I forget what it was called, and they said, well, we can be really fast and scalable, and who's really going to try us on security? And they were very rapidly, it transpired, actually, no, as soon as someone saw that they hadn't built their blockchain to be secure instead of fast, they exploited it. They've tried to be fast, and they've run into problems because that traded off security. Again, you have to go down to the physical world, right? It takes time to get a signal over a network connection. It takes time for a computation to run. If enough nodes on the network don't have enough time to catch up, then you're going to have a consensus failure. And again, that's not the whole story there, but that is part of the story, and that's an important design consideration, is making sure that you always have reliable consensus. And that does take time, and you cannot, if you try to run too fast, you're going to fall on your face, basically. So here we have the things that go into a model, right? We have the known knowns, the known unknowns, the unknown knowns, and the unknown unknowns. Things that are in the model explicitly, you're like, okay, I expect this to be true. In Bitcoin, we explicitly model the way the hash race works. Things that are in the model probabilistically, we're assuming that everyone's going to have computing power that they're applying to this, and no one person is going to be, we know, but we don't know what the actual computing power out there is, but we know we don't know it, and we can probabilistically account for what we don't know. We have things that are in the model implicitly. So related to the private key, the fact that you cannot actually break with current computing power the public-private key encryption that we currently use to secure wallets and stuff like that. So it's implicitly there. The assumption is no one's ever going to be able to break that. If quantum computing comes along that is going to upset the apple cart on cryptography, then maybe that is incorrect. And then we have unknown unknowns, which are not in the model, right? And this is stuff, out of nowhere. There's a dependency somewhere in your tech stack, and someone manages to exploit that dependency and make a change to the code, which is then which no one knows about, right? Which is then propagated, and all the nodes are compromised at the same time. But if you didn't know about that dependency in the first place, then it's very, very hard to defend against that, right? Everything else you can say, okay, I've thought about that, or at least I understand that it's out there and I don't know, but I can put parameters around that. It is the things you don't know that are going to come out and bite. This is just something to think about. I certainly don't expect you guys to be, going through your laptop looking at all the chips with a magnifying glass. But just to be aware of, when you're thinking about these systems at the design level, you want to be thinking about, what are the failure modes and how can we mitigate that? And this is one of the wonderful things about blockchain. Again, if we have this large number of systems that are independent, then we can have a system up here that works reliably, even though all the components it's built on are not actually reliable or even exploitable. The thing is, we then have to avoid the exploits we can build in at this layer because you know the story of the DAO and every hack ever since, right? There's a lot. And this is vital because this technology is really about trust. And if people can't trust the technology, then they cannot use the technology. So this is where we create value in this space, is by making sure the system is mathematically robust and properly constructed. So here's an example of consensus wisdom, the stock market, right? IBM, huge corporation, it's been around for, I don't know, 100 years or something. And how do we assess the value of IBM? It's got a lot of smart people, it's got a lot of patents, it's got a lot of technology, it has physical property that it owns. You know, it has products, it has customers, it has an annual report it writes that says we made this much money and these were our expenses. But the stock market somehow finds a value for the price of a given share of IBM. And this is a crowd wisdom function. In practice, what happens is we're investing in a company, we're investing in stocks when we expect to make profit, right? No one's going to invest in a company they expect is going to go down. They're going to short it, right? There's two ways to do this. I mean, there's more, but in a broad sense, there's two ways. Fundamental investing. So this is where you actually go and you study a company in detail. You get into who their customers are, you get into their revenue streams, you get into their leadership, like you just get into the weeds on this company. And at the end of the day, you're going to say, this is how much we expect they can make, and this is, you know, what maybe their issues are. And we are going to make a decision based on this detailed technical understanding of the company. That's a lot of work, right? But it displays negative feedback. Fundamental investing displays negative feedback because if you find a company is undervalued, you're going to invest in that company because you're like, oh, I can make money here. And then you are going to say, you know, bring the price up a little bit. And if enough people are doing that, the price will rise until maybe it's overvalued, and then people think, oh, actually this has gone a bit too far, and it's going to fall, and it's going to do this, and it's going to seek a level. That's what negative feedback does. Technical investing is much less work. All you do is you look at the whole stock market and you say, what's going up the fastest today? I'm buying that, right? What happens? Everyone else, that makes it go up faster. Everyone else says, oh, I'm buying that. They all pile in. Right? Until someone's like, you know, this is getting a little crazy, and they all pile in again. This is a bubble. This is positive feedback. To return to the stock market, does anyone think the stock market actually works in terms of setting prices for companies? Just give me a yes or no on average.
Yes.
Yes?
Yes, kind of.
Yes, kind of?
Maybe.
Oh, indeed. Well, there's the answer. Every one of those recessions, what's happening here is that too much gets poured into an overheated market, and then it can't meet the expectations, and then it all comes out again, and we get recessions. And we see this in the stock market, the very same thing, right? The valuations going up and down. This is the game of markets. There are people who play this full time, and their whole job is to actually make sure they're making the right calls. So arguably, you have enough smart people with the wisdom of crowds trying to do this. Arguably, you get close to the right answer most of the time. In this case, obviously, you don't get the right answer all the time.